Welcome, everybody, to another episode of the Lost Coast podcast. Today's guest is Christopher Price, and he specializes in real estate investing. And he's going to chat with us today on his knowledge and his background and how he got there in the real estate world. Christopher, welcome to the show.
Hey, Cory, thank you for having me. I appreciate you letting me share your platform. It's really an honor and a pleasure to be here.
We appreciate you being here. Just for the listeners' purposes, let's give just a little bit of a background on yourself and how you've got to the real estate piece that you're in now today.
Absolutely. So yeah, what I like to tell people, Cory, is that I oftentimes introduce myself as Chris Price, and I tell them that I'm a pharmaceutical executive by day, but a real estate investor by night. And really, I got into the real estate space, similar to how some other people get into this space. My wife and I, we have been, along this journey of, doing all of the things that folks have encouraged us to do throughout the years. Hey, get a good job. When you're in that good job, save in your 401k. You make sure it has good benefits. Make sure you max out that 401k too, so that you can really take advantage of that. And if the company has a company match, you want to take advantage of those things. And we did those things, and all of the things that can come with that, we recognize. But also along that journey, what we recognize is that the volatility of the financial markets and the roller coaster that things go on was something that was really not an ideal space to be in with respect to how we wanted to go about investing. And so we did some of the things that some other folks do. We learned a little bit about investing in real estate. We got into single family homes, kind of that became those accidental landlords where we were starting our family. And as we were starting our family, and rather than selling the condo that we had, we decided to hold on to it while we moved into our new single family home to raise our family. But while we sold that while we moved into our new single family home, we now had another asset that we were able to rent out and get a little cash flow from those things. And we did that for many years, not really thinking much about what was happening. Someone else was paying down that mortgage, and we were getting a little cash flow at the end of every month. And we didn't really think much about that. But then we started to get smart about things, years later, when we came across that purple book, that Rich Dad Poor Dad from Robert Kiyosaki, and started to gain some interest into real investing in other things, investing in real estate, investing in businesses, and those types of things that really started to pique our interest. And the journey kind of begins from there. And I'll certainly get into some of the specifics as we go on throughout the conversation today.
Yeah, no, that's great. I mean, we kind of follow suit there. I was in the construction business, dabbled in real estate and that, and I've transferred over to financial consulting side. So I understand exactly what you're coming from. The whole idea, like you said, go out, get a good job, max out your 401k, all that stuff. It's proven today from the baby boomers that are retiring that has not quite worked out as well as they had planned. They're still having to find a second job to subsidize their retirement. They're not retiring on how they thought they were going to be. Just the market volatility is a dangerous thing to play with when you got real estate, which is, I'm not saying it's not volatile by any means, but it's more consistent, and then they're not making any more of it. You know what I mean? This real estate is a piece that is there, and it's not going nowhere. It's
That's right.
people need places to live. Everything's growing, so it's real estate's a great piece to put your money into. And so tell us exactly, kind of give us a brief overview of what your real estate strategy has been.
Yeah, so today, I'll start a little bit and give you build on a little bit more from that journey from being single family investors to now what we're focused on doing. So as I mentioned, we got into single family investing as accidental landlords, and when we started to build out some gain some cash flow, really start to get more focused on devising a plan to build our real estate portfolio And in that journey, we also started to learn about things like financial freedom and financial independence, and how would we be able to accomplish those things in that journey. I came across many different people. I came across people like Michael Blanc and Brad Sumrock, and I started listening to the real estate guys, and came across Ken McElroy and a whole host of other names that folks out that were out there doing things and investing in real estate, and people like Keith Weinhold also that was a very influential in my life at that time. And I was soaking in all of this information, learning about everything in all of the books, and we in podcasts, I should say, and YouTube videos. So I went deep down the rabbit hole to learn as much as possible. But in that journey, as we were looking to be able to, build our real estate portfolio, we had laid out a clear plan around how we would acquire, a number of single family homes to be able to replace our earned income from our W-2 jobs, and then, achieve that path to financial freedom. But in that process, what we learned was that we learned that it was going to take us a whole lot of single family homes, and a lot of time, more time than we were interested in overall, to be able to acquire enough assets to be able to replace our earned income from our two corporate jobs. And so, and rather than going down the path of single family, we pivoted and started to look into going into commercial multifamily syndications. And this is in and around the time of 2018, 2019, when we started to really get focused on these things and move into this space of real estate syndications. And I was in that time attending many different virtual meetups and getting to network with people. And I was attending meetups live and meeting different operators and learning from other investors, just really to increase my knowledge and awareness around what other types of real asset investing people were doing. But then, in that process, we then took a leap and said, you know what, all of this information that I'm soaking in, we really have to take action on these things. We're talking a lot about things and we're learning a lot, but we're really not taking action. So, fast forward into the pandemic in 2020, we started really honing in on what we were going to focus on investing in. And it wasn't too far after that we invested in our first commercial multifamily deal as passive investors. And that quickly led into multiple other passive investments where we were able to get some cash flow from these properties and start to really understand that passive nature. I have to say one thing. One of the things that was really influential around why we decided to go into the passive investing space instead of going more into the single family home spaces, because we had some positive experience as single family investors, but we had a couple of not so good experiences as single family home investors, with some tenants that were very that tried to take advantage of us, and it just left a bad taste in our mouth. And we said, we weren't really interested in doing that and continuing to build on those things and add that stress, but passive investing was something that was really interesting to us. And so we went down that path of becoming passive investors into other people's deals, where people could bring us opportunities. We would learn how to evaluate those opportunities, and then we would invest in them to be able to diversify our portfolio. And what I learned in that process was that I really was passionate about this space of real estate investing. And in fact, me as a pharmaceutical executive, that there were other people like me that were out there doing all the things that they were told in terms of 401ks and IRAs and playing in the stock market, that's the only way that you could do it. And I thought to myself, man, there's an opportunity for me to be a thought leader in this space, that I could go out and educate others, and from my neck of the woods, from around this idea of passive investing in commercial multifamily real estate. And so I took that and decided to get into starting our own business as a real estate syndicators. And that journey was really just a fascinating journey, from going from a passive investor, having some success in that early, to then pivoting over to then being an active investor. That was something that was really important to us, and that led us to creating our first company, which is Red Fox Multifamily. Which in fact is where my, named after our alma mater, where my wife and I met at Marist College in upstate New York, and kind of the rest goes on from there.
So you took your alma mater, and that's how you started your business. You took the name from there and ran with it, huh?
That's right. The mascot was the Red Fox, or is the Red Fox, I should say. And we had met so many of our dear friends and people that are in our lives to this day, and we connected with them. And when we were talking about names that we would name our company after, Red Fox Multifamily was the name that we started with. And what was fascinating about that is that in that time, as starting our company, Red Fox Multifamily, we also, we had some success in getting off in investing, and in that time I had a mentor, and my mentor was kind of guiding me along the way and helping me, inform my decisions around different investment opportunities around multifamily investments that we were getting into. And, in that time, as I was continuing to grow and scale my business, he actually said to me, "Hey, about a little over a year in, we're looking to, I was explaining to him that we're looking to scale our business and move into some other spaces. And he said, "Hey, we're looking to do the same thing in our company. And it would be really interesting if you would be interested to see if you want to join our partnership. We've been looking for the right partner." And that was really a fascinating idea, because it was something that I hadn't considered at that point in time, but really focusing on just continuing to execute our business plan. And that opportunity for us to then take a look and say, "Hey, maybe we can join forces formally to be able to scale together," that might be the right strategic move. And so we spent several months, doing due diligence, evaluating whether or not we would be the right fit for each other. And lo and behold, we were. And so now Red Fox Multifamily is a part of Boost Capital Group, and Boost Capital Group is a private equity real estate fund of funds where we raise private capital from passive investors to allocate to commercial multifamily deals and other passive investments to help people diversify their portfolios and build wealth passively with real estate. And so that's where we are today. And we have had some great success and partnering with these operators to be able to help people diversify their portfolios, add additional income streams, and that's what I'm focused on today.
So so other people, these investors can come to you guys, invest money with you and then get residual income, correct?
That's right. That's
What
right.
what are the returns that we're looking at? The average, I'm sure that's different for each situation, but I mean, what's kind of like an average return someone can expect?
Yeah, it's a great question. And as the market cycle has kind of evolved over the past couple of years here, with the with varying interest rates, different asset values, return profiles have varied as well. But what we talk about in the types of investments that we focus on investment on some very specific things. I would say, first and foremost, before I even get into the specifics of the actual returns, some of the things that we look into and we pride ourselves is on our due diligence. We want to make sure that first and foremost, we are helping our investors get into the best assets and the best markets with the best operators. And so we have, we do a lot of due diligence to ensure that we're getting the highest quality of operators to be able to achieve those things. And in that, what we're looking for in those markets and in those assets is we're looking for operators, these folks who this is their bread and butter. What they do is acquire these assets and get them to perform at the highest level. So we're talking about looking at operators who have over 1,000 units of assets under management in their market. We're talking about operators that have at least $100 million of assets under management in a particular market, and they have a track record of doing and successful performance for at least 5 years. And so, with all of that context, when we talk about our track record and what we're doing, Boost Capital Group today, collectively, we have over 4,000 multifamily units in a portfolio of over $400 million, and our average annual return is about 20%. And what we look to be able to do, and when we speak with each investor individually, is we look to help investors double their investment in a 3 to 5 year time frame. That's about how long it takes for the business plans of these assets to be executed. And so we're essentially looking to help folks turn that passive investment of 50, 100, or whatever the case may be, $1,000, invested into one of these assets, and then turn that and double that money into a $100,000 investment, with the return of their principal investment plus the cash flow that comes with it, and the proceeds from the sale of the property when the property sells at the end or exit of the deal.
Awesome, awesome. I mean, they're making something basically at every stage. I mean,
That's exactly right. So yeah, let me get into that a little bit more. When you become a passive investor into these commercial multifamily deals, it's think of it like a fix and flip, if you will, but instead of a single family home, we're talking about a 100 or 200 or 300 unit apartment complex. And so in that, I should say, investors are getting a lot of diversification in terms of that asset, because you're not just reliant on one single family home. If it goes vacant, then you're 100% vacant. But in a multifamily complex of 100 or 200 units, if there's a couple of vacancies here and there, it's not going to crush your deal. And of course, you're going to execute a business plan. Your property management team is going to go ahead and make sure that unit gets filled, so that we're continuing to generate income and revenue from that deal. But the reason why I wanted to bring that up is because as investors are invested in these investment opportunities, as the business plan is being executed, during that process, what's taking place is, it's generating income. It's generating income in multiple different ways in the type of strategy, the value add strategy that we focus on. First and foremost, the income is being generated from the cash flow that the property is generating from the rental income that all of the tenants that are paying rent at that property is coming in. In addition to that, many of us who have lived in these types of complexes before, what else is there that generates income? Well, there may be parking fees. There may be laundry fees. There may be fees for using the um the facilities and the exercise facilities, and you can name it, and other types of amenities that these types of complexes have. Maybe there's a dog park, for example, that exists, and you pay a $30 pet fee. All of those things are income generating, but you as a passive investor would then be able to receive your proportional share of those cash flows that are coming in from the property. And so all the while you're investing in this, not only are you receiving cash flow distributions, typically on a monthly or quarterly basis, it's at the end of the project where the big payout typically takes place. That when we sell the property or refinance it, they will receive, the passive investors will receive their proportional share of the proceeds from the sale of that property. And investors can decide on multiple different things. If they want to reinvest that into other projects that may be coming along their line, or if they they're paying for someone's college or whatever the case may be. There are different ideas around how people use that money, but it gives you another income stream of cash flow coming in.
That's awesome. I mean, the cash flow is king, right? I mean, that's the piece. As everybody says, cash king, cash flow is king, because it doesn't matter what you got in your hand, it can disappear, but if it keeps flowing in, you're good to go.
That's right.
So the end deal, I agree, is totally when the bigger payout comes in, right? The cash flow is kind of just to keep things moving, keep things alive, and that big deal is what comes in when you guys sell. What have you seen as been your guys's, like, I guess the way to put it would be the hold period, like, time of purchase, time of sale. What kind of time frame are those roughly? And I know it's different for every project, but where are we at there?
Yes, it's such a great question, right? Because what we're typically doing, I talked about very briefly, the idea that we're focused on is and a strategy that we primarily focus on is a value add strategy. So what does value add mean? Value add just simply means we're looking to increase the income of the property and reduce the expenses of the property. And this oftentimes takes time. So, first and foremost, when these properties are acquired, we're looking to have them be acquired at a discounted rate. Typically these deals are off-market deals that we're focusing on, so that there's not a lot of competition that's driving up the price of the asset. But then in addition to that, in what is being targeted in the first place, there's really looking at a lot of opportunity around what with each of these particular assets can we improve to be able to increase the income and reduce the expenses. And so we're looking at, hey, we when we are buying this asset, this is actually showing that we are, the rents that are being paid collectively on average across this asset are, $200 per month below market rent. Okay, well, why is that? And well, the ownership, the current ownership just hasn't increased the rents, or maybe they just haven't been, focused on rental income, or maybe the amenities that exist currently aren't at the same standard as the amenities that exist in the other comparable assets that are in the 1 to 3 mile vicinity of our property. But if we were able to implement new amenities and upgrade each apartment unit, and add that dog park, for example, would we be able to command that $200 per month increase in rental income across all of these assets? And if the answer to that question is yes, then that's certainly an indicator for us to be able to do that. And so when we acquire the asset, I wanted to provide that context because it's important.
Hmm?
Because when we then acquire that asset, what's happening over the course of a 3 to 5 year period, for example, is the business plan is being executed. In most cases, the in year one of the business plan, that is when the heaviest investment, a lot of the capital expenditure is going into that asset to start to renovate units, to add those LVT flooring, and add those granite countertops, and all the things that our comparable properties in our that our competitors are doing to bring our asset up to the same standard. Because we know from our market research that if we're able to bring that asset up to the same quality, then our rent, we can then increase it up to that $200, increase it up by $200, as I was mentioning earlier. And it's at that point in time that we're making these investments and making these improvements to the assets. We're adding that dog park. We are improving the pool facility so that people can take advantage of that even more. Or maybe there are other amenities like a trash valet, or some other parking type of things that we can do. That's all on income generating side of things. But in addition to that, there's opportunities for us to improve things on the expense side as well. And you would know this as a contractor. One of the things that we've looked at from a expense standpoint is high water usage. In some one of the assets that we've invested in, we looked at, as we took over the property, we were examining the water bills for the particular unit, and people are like, maybe like, oh man, what does that even mean? Well, we noticed that the water usage was actually so high because we had high water flow toilets. And if we could simply switch out those high water flow toilets over to low water usage toilets, that would help us dramatically reduce our water expenses somewhere around a third, if you will. And so it's simple things like that we can make these types of decisions to improve the operations of the property. And this is happening over that time period of 3 to 5 years, where you were receiving cash flow distributions from that. And then once we are done with the business plan, in most cases, what we're looking to be able to do is sell off that property and exit the deal. And we're looking to be able to distribute those proceeds from the sale to all of the investors in the deal, so that they can then receive their equity multiple and take that money and do with it as they please. Most people that we invest with know about the velocity of money and the importance of then being able to take that and reinvest it into another asset to take advantage of tax benefits, but also continue to generate passive income with their investments.
Yeah, that's awesome. I mean, it makes perfect sense. I mean, so it's not like you're waiting 20 years. It's everything's in place. The plan's in place. It's just everything's getting executed. You're taking the cash flow during those times, and then you're waiting for the big payout. I mean,
That's right.
that's a key piece to success, really. And you guys seem to have it all kind of just structured and ready and played out. I mean, to catch the toilet thing, that's a huge piece. I mean, those are things that most people would overlook. I mean, it's one thing if you've got, like you said, a single family home and you're worried about two toilets in a house,
Right.
that's nothing, right? But when you got units, hundreds of units, and they each got two toilets in each one of them, that's a lot of water.
That's right.
That's a lot of different numbers
That's
there you've got to deal with.
That's exactly right. And these things really matter when you because what you're talking about is you're talking about scale, right? When it's 200 units, and you have built that into your business plan. It's all a part of your capital expenditure, right? So we're not robbing Peter to pay Paul here. This is all a part of we know going in that we're going to replace of the 150 unit apartment complex. We know that we're going to replace 100 toilets or 200 toilets, because we did this underwriting and put this all a part of our business plan. And so when we're raising capital from the investors, and we know what we're going to be doing with our capital funding that we get from the lenders, all of this capital is set aside to be able to execute that business plan. I talked a little bit. I want to make sure that I cover this one thing briefly as well, because I did talk about the big picture returns around doubling investors' money in that 3 to 5 year time frame. And we have talked a little bit about the cash flow, right? Cash flow is king. Right now, as I mentioned, when we were in a higher interest rate, environment, during that time period, cash flows, annual cash on cash return, or cash flows that were taking place, certainly got eroded away from. There was just no way to run away from that. Where we were typically seeing an 8% cash on cash return on average in terms of our target, we saw that get eroded down to about 5%. So what that means to the passive investor, that means on a $100,000 investment, you would expect in this market cycle that we're in, annually $5,000 of cash flow per year on average, as a passive income stream of cash flow coming in, just as an example. But as we see things changing over here, and we start to potentially get into a more favorable interest rate environment, and values continue to go up, and we can find expenses also are managed properly, perhaps we'll see some increases in type of cash flowing assets in the markets that we focus on. And that, I would say the context to all of this is that it's not a one size fits all from a market perspective. We focus predominantly in strategic markets in the Sun Belt. So that's everywhere from the Carolinas, Tennessee, Georgia, parts of Florida, all the way to Texas and Arizona. In some of the markets that we focus on, the cash flows are a little lighter. But in other places, in some places in the Midwest, or in the deep South, where people may focus on those types of assets, they may be able to get a little bit more cash flow. But we do not focus at all in markets like the coastal markets like California, where you are, or New York, where I am, because we know that these are not landlord or business friendly environments. And as a result of that, what we're all focused on doing is making sure that we are providing, we're stacking the deck in the favor of our investors, right? And by doing that, by putting us in more favorable landlord and business friendly environments, and assets that are essential to people's need. People need, as you started earlier, Cory, people need a roof over their head, right? And so our thesis is focusing on doing those things, investing in these types of assets because people need these things, and rightly or wrongly, people will make decisions, when they're trying to decide on, hey, will I go to the pharmacy and pick up my prescription, or will I pay rent this month? This is not to trivialize this, but these are decisions that people have to make. And more often than not, people are going to pay their rent to keep that roof over their head, to make sure that they are sheltered and their family is sheltered. And so we look to be able to focus on those assets that are essential in our society, because those are the things that tend to have, or I would say, are more recession resilient, if you will.
Yeah, absolutely. That's one thing about real estate is it's pretty recession proof piece of material. I mean, it does fluctuate, but it's there when everything comes back, and it comes back the fastest.
Yeah.
It's really the biggest. It takes longer for it to drop, and it returns the fastest. So it's got got a lower dip in the whole situation. Yeah. So these products here, and not products, but this investment tool that you have, what is there like? What kind of investor? How do you qualify your investors?
Oh, such an important question. So there are multiple types of investors, if you will. There are accredited investors and there are sophisticated or non-accredited investors. I will say up front, our fund is focused on accredited investors, and the SEC, Securities and Exchange Commission, have defined accredited investors as individuals who have made $200,000 or more for the past 2 years, and or they have a net worth of $1 million, or they have certain financial certifications like a Series 7 or a Series 63, or some other financial certifications. That if they have any of those things, it doesn't have to be all of them, but they may have one of those types of things to meet that test, and they would be considered an accredited investor. And again, I should also say they also must have a reasonable expectation from the income standpoint. If they're qualifying in that way, for example, they must have a reasonable expectation that in the next year, that they will be making, as an individual, $200,000 of income as well. And if they're a couple filing as an accredited investor, it's $300,000 for the previous 2 years, and the year upcoming. And so, with all that context, the accredited investors do have access to more investment opportunities, because the government believes that accredited investors typically, they may have a bit more of an opportunity to, or because of those criteria that I mentioned before, the ability to assess investments in a different way, or maybe be able to tolerate a little bit higher risk. Whereas sophisticated investors, they want to make sure that the bar is set a little higher for them, for investment opportunities to be able to get to them. But I bring this up because in this context, that what you're going to see in these types of investments for accredited investors, you're going to see a 506C for accredited investors and 506B for non-accredited or sophisticated investors. And once those folks are qualified, and they see the types of opportunities that are out there, they're going to be able to do a few different things when these investment opportunities come across their desk. There are going to be opportunities for them to meet the operators, folks like me. You'll schedule time with me. We'll talk about what your investment needs are, what you're exploring, whether or not this is right for you. This is not right for everyone. Some people may need to just focus on some other things. Maybe you have a lot of capital tied up into your kids' college, or maybe you're doing a big renovation on your house, and you don't that liquidity that you were planning on investing is going to be redirected somewhere else. Perhaps this is not the right time, but For others, who are looking to diversify their portfolios and add passive income stream, this could be the right time for you. So you'll talk up to us, and we'll get to know each other and do that due diligence. And then there'll be opportunities for folks to join, in our case, our investor club. And what that means is that folks that join our investor club will receive ongoing email information around what's going on in the real estate market, a lot of educational information to keep them up to date in this space. But then they'll also receive investment opportunities as well, which we will send out to everyone when we have investment opportunities for them to evaluate. And they'll be able to have a dedicated portal where they'll see these investment opportunities. They'll be able to watch webinars and read the prospectus of what and the business plan for each of these deals to see if these are things that they want to be able to invest in. So it really gives people a real uh, you know customized, personalized experience so that they can really tap into these types of investments to see which ones they might be interested in pursuing further.
Okay. All right. Well, boy, I had a question for you, and I'm just so in tune to everything you're saying that I kind of forgot it. But so what's if there was an investor, that's listening to this podcast here, and they're like, that's kind of interesting. What's the best way for them to reach out to you?
Well, so first off, I would just say, I'm super accessible. People can reach out to me in many different ways. I first say that I am very active on social media. I love connecting with people and helping them understand about this. So, I'm most active on LinkedIn. I'm also on Facebook and Instagram, but on LinkedIn, you can find me at Christopher Price MBA. You can also find me on Instagram at the real Chris Price, and Facebook is Christopher Price as well. But the long story short, what I would tell people is that if they want to reach me, I have created a free webinar for people who are interested in learning a little bit more about this. They can go to boostmycapital.com/investor webinar, and that will then allow them to learn a little bit more about this idea of passive investing. And if this is something that they want to learn more about, they can then they'll have an opportunity to schedule time with me to be able to talk a little bit more about this, and we can get into some specifics about whether or not this is the right fit for them.
Excellent. I remember my question now. So
Sure.
the investor, now they've reached out to you, right? So now you've had this one-to-one, and now they decide, I want to give this guy, I don't know, 500,000, right? They have that kind of funding. And they get this, you take the 500,000 from on this project, right? Do you guys already have the project picked out, or are you raising the money, then going and finding a project? And the second question with that is, when this is in process, do you ever are the investors ever need to put more money in, or is this like a one-time investment?
So this is a great question, Cory. So to answer your first question, we have what's called a customizable fund. And so the customizable fund means that we actually, in most cases, we know the deals that we are investing in. We bring all of those investment opportunities into our investor portal. And you in that investor portal that our investors would have access to, they'll be able to see the projects that we currently have available for folks to invest in. Almost like, think of it like an E-Trade or a Robinhood account, but instead of choosing different mutual funds to invest in, you're choosing different alternative assets like multifamily real estate projects for you to invest in. So you'll see that 600 unit apartment complex in Houston, Texas, and you'll see the 200 unit apartment complex in in Charlotte, North Carolina, but you'll also see some other investment opportunities. And that investor that has $500,000 coming in that's ready to allocate to create some passive income, what's the benefit of what we have available versus those blind funds that you described just a moment ago is that they have the ability to choose which type of investments they want to invest in. So if they want to put 100K into the Charlotte deal and 200K into the Houston deal based off of their interest into those things and which markets they feel or which investments provide them with the best opportunity to diversify across geographies and diversify income, etc. They'll be able to do those things within this customizable fund. And what's beautiful about this is that all of this is happening within their secure online portal. They'll be able to see their allocation amounts, how much money they have available to be able to allocate to different deals. They'll be able to see the cash flows that are coming in from each of these deals when the distributions are coming in. They'll be able to see when things are selling or not. So all of that information is in one-stop shopping. All of their legal documents and business plan documents are all there available to them. And of course, we are always accessible, and we work with our operators very closely to be able to get this information and make it available to them so that they can have a great customer experience. That's what we pride ourselves on. Beyond the due diligence, we want to make sure that people have that customer experience because we're interested in making sure that they can achieve their goals and they can continue to come back and invest alongside of us.
Very nice. Very nice. That's great information. I got lots of stuff running through my head, I know. So before we bring it to a close here, Christopher, first of all, I want to thank you for coming on the show. But what's the best advice that you could give our listeners today on the real estate investing piece?
Yes, this is an important question for me, and along my journey here to becoming a real estate investor, there really have been a few people that have been really influential in my life, and some of them are sort of mentors to me, that I picked up along the way through their teachings, and one of them is Jim Rohn. And Jim Rohn, he famously said that a formal education, things like going to school and getting all the degrees, and I did all those things. I've gotten my MBA in healthcare management. I've gotten my Lean Six Sigma certification, project management certifications, and a whole host of other letters and certificates along the way of my professional journey. And that's all that has served me well for building a really great career in the pharmaceutical industry, where I get to help patients. But on the flip side of that, he also said, your self education and your personal development will make you a fortune. And then that has hit me so much because with all of those letters behind my name, I then transitioned over to investing more into myself, more into my personal development, more, joining different masterminds, getting certifications in this space of commercial multifamily real estate investing so that I can become an expert in adding value to other people, and helping them get what they want. You know the famous quote from Zig Ziglar: "You can have everything in the world that you want if you can just help enough people in the world get what they want." And I truly believe that. And so in investing in myself and being very focused on that personal development and becoming a master of these other areas that we're talking about here, I can then be a beacon and an asset to other people and helping them achieve their goals financially, in this case when it comes to investing passively in real estate. And then for me, going from there, that then gives me an opportunity to just continue to kind of grow from there. So I would tell people, invest in their personal development, invest in themselves, because they are, in fact, we're talking about investing here. The best investment is in themselves, as Jim Rohn has said, and I would encourage people to do that.
All right. Yeah, I don't know how to say it any better than that, Chris. I mean, you mentioned two of my favorite guys, Zig Ziglar and Rome. I mean, they're amazing on the information that they've given us. With that being said, Chris, I want to thank you again for being on the show. This has been great information. I know I got a lot out of it, and I'm sure my listeners did too. So with that being said, this is the Lost Coast podcast, and we are coming to a close and signing off. So we thank you all for listening, and we will see you all next time. Bye.